If you've inherited a property and you're thinking about selling it, there's a tax rule I want you to know about before you do anything. Most people have never heard of it. And once you understand it, you may realize you're looking at one of the most valuable tax benefits available when property passes at death. It's called the step up in basis, and it could mean the difference between owing a large capital gains tax bill and owing very little, or even nothing, depending on the numbers. Let me explain exactly how this works. So first of all, what does basis mean? When someone owns property, their cost basis is generally what they paid for it. So for example, if your mother bought a house where I am in Wilmington, North Carolina in 1987 for $85,000, her basis in that property is generally $85,000, subject to adjustments over time. Now, over the next 35 years, the property has obviously appreciated. So let's say now it's worth $425,000 at the time of her passing. Under normal circumstances, if she had sold that house during her lifetime, she may have had a large capital gains. Now, if she'd sold that house during her lifetime, she may have had a large capital gain. That gain would generally be taxed federally, and North Carolina would also tax it under its state income tax rules. But she didn't. She passed away, and that changes the tax basis analysis. And here's where the step up comes in. When you inherit property, your tax basis is generally reset to the fair market value of that property on the date of the death, although in some cases an alternate valuation date may apply sometimes. So in this example, your basis may not be $85,000 that she bought it for anymore. It may be $425,000, which is obviously what it's worth now. So if you sell that same house for about $425,000, your taxable gain may be little to none. In other words, the appreciation that happened throughout your mother's entire lifetime of owning that property may never actually be taxed to you. But any increase in value after her death could still create taxable gain when the property is sold later on. Why does this matter so much for executors and heirs? Well, it's because a lot of families make decisions about inherited property without knowing this rule even exists. They rush to sell because they assume that a huge tax bill is coming, or they hold on to the property longer than even makes sense because they're afraid of taxes that may not apply to them the way that they think anyway. Or they hold onto the property longer because they're afraid of a tax that may not even apply to them the way that they think. Getting the timing right and understanding what you may actually owe starts with knowing your stepped up basis. Let's briefly talk about what assets get the step up. Real estate's the most common example. It's the one I work with the most. But this rule can also apply to other appreciated assets included in the descendant's estate, like stocks and taxable investment accounts. The things that don't get step-ups are retirement accounts like IRAs or 401ks. They generally follow different tax rules, and those are usually taxed under income tax rules that apply when the money is withdrawn from those accounts. Trust assets can also be different depending on how the trust was structured. And in North Carolina, which is not a community property state, jointly held property often gets a partial step up rather than a full one. So the exact ownership structure matters. Here's one more thing that surprises people. The step up is based on the fair market value at the date of death. That means getting a good valuation and getting a good valuation documentation is important, especially if the property won't be sold right away. So you want to get that valuation done as quickly as possible after day of death. A professional appraisal close to the date of death is usually the strongest documentation. So the bottom line is, when you inherit appreciated property, the tax basis is often reset to the value at death, and that can significantly reduce the capital gains tax exposure for all the heirs. So know your tax basis before you sell. Get the property valued properly. If you're not sure how this applies to your situation, which most people aren't, talk to a CPA or a tax professional who works specifically with estate matters. And as always, I help executors manage probate in North Carolina. If you have any questions, need any guidance about your specific situation, please reach out anytime. My name is Ryan Smith. I offer guidance to executors going through the probate process. If you have any questions at all, you need any guidance about your specific situation, I'd be happy to help. Please feel free to reach out anytime. Thanks for watching.